And while we prepare the stage for the first panel discussion, it's my pleasure to introduce the panel itself. We have Mark Florance, the investment committee member from Climate Fund Managers. We have Han Meng, founder and director, ADL Capital Group. We have Saowalak Maliwan, Fractional executive, Super Energy Corporation. Priyanka Mehrotra, investment director, Mirova. And Fatima AlSuwaidi, head business development at Masdar. And the panel discussion will be moderated by Shantanu Jaiswal, head of South and Southeast Asia research at Bloomberg New Energy Forum. And I will hand it over to Shantanu to get the panel discussion started. The panel is about unlocking capital markets, strategic partnership models between project owners, technology providers, and investors in Asia-Pacific solar and storage landscape. So all the big announcements in projects, both on the solar and the storage side, they have to be funded. The money has to come from somewhere. And we are very curious now to hear where the money comes from and how we can facilitate it in the right direction. So I hand it over to Shantanu, and I would ask all the panelists, please move on stage. Ideally in the order of where the names are placed on the display, so that people can identify you more easily. Just 1 minute to get the glasses with the gin tonic on stage. To relax a little bit for the panelists. Wonderful. In the meantime, enjoy the hotel lobby music which we have here in the room. Please, may I ask the panelists to go on stage, and Shantanu will take over from here. Thank you. Enjoy.
Thank you very much, and good morning to everyone on the day 2 of ACES conference. I'm really happy to see people over here, the house full over here. A lot of excitement about clean energy financing. Since the end of the pandemic, what we have seen is that the financing activities for clean energy has increased quite a bit in Southeast Asia. So we at BloombergNEF, we track every dollar that goes into various segments of clean energy or energy transition industries, and we track these numbers on an annual basis. And in 22, what we saw that the total new debt and new equity that went into building clean energy projects, renewable energy projects in Southeast Asia was around $4 billion, just above $4 billion in 22. In 26, it became $6 billion. Last year, it was just above $8 billion, all new debt and equity without refinancing or anything. And while I don't have the numbers for Southeast Asia for now, for this year, but the interim data suggests that globally, we are going to surpass the levels that we had reached last year. So by that measure, I'm assuming that Southeast Asia will again have an increase, and I wouldn't be surprised that we cross $10 billion worth of new debt and equity that is raised for Southeast Asian projects this year. With that, what I'll do is we'll open up, we'll do a nice discussion. We have a very diverse set of panelists, so it was difficult for me to figure out how do I contain them to about an hour, but I hope I'll be able to do that. And at the end, I would also like to take a few questions from the audience. So if you have any questions, please do let us know, and we'll try to, I'll try to build them into the discussion as much as possible. And to kick it off, Mark, I would like to bring you in first, on this discussion. So your company, and by the way, please do take the time to introduce yourself or what you do, just so that the audience is also aware of what kind of questions they could ask you. So, you focus a lot on asset developers and financing them for various renewable energy activities. So what are the most critical financial or capacity gaps that you see in local Southeast Asian developers? Because many times what we see is that the developers, local developers, they are so attuned to getting financing from local banks that they don't understand sometimes what is happening at the global level or what are the requirements of it. And the second part is, beyond just providing capital, are there any specific strategies that you are looking or that you are adopting to make sure that the companies that you invest in are able to get conventional financing, a few years down the later?
Thank you. So my background is obviously in energy, but the fund I'm involved with is called Climate Investor 1 and Climate Investor 2. Climate Investor 1 does renewables in Asia, Africa, and Latin America, and Climate Investor 2 does the same, but it does it for water and for waste, and mainly waste to energy. And this is a blended financing fund. So I guess that means that there is DFIs as well as institutional investors. The main DFIs are FMO out of Netherlands and the EU. And so in the context of your question, both funds are about $1 billion, and they're 20-year funds. But in terms of the question is, what do developers, I guess, lack when they come to us in terms of their understanding of what is required for funding? I think the answer to that depends a little bit on who the developer is. Now, the reason I gave you my background is that we would typically work with people who can't obtain funding through banks. So so essentially the project is unbankable from a bank's perspective. And therefore, they need things that would, I think if you're a sophisticated investor, you'd probably get bank funding. But we try to, through the blended financing structure, be a catalyst for funding projects and therefore developing a market in renewables in countries that would otherwise struggle to put these projects in place. So what do developers lack? I think a lot of them just expect you to, okay, we've got the project, we've got the idea, we've broken ground by clearing the site. Now, can you please send us a check? No, well, I think it's a bit more than that. We can't just wire you the check or show you proof of funds. What we need to do is help you get to the stage where the project becomes financeable. In our case, we finance it through equity. So we don't use banks at all in the first stage. We build it first, and then we refinance it. And that is, again, because bank financing typically isn't available for these projects. So what do developers lack? They really lack a fundamental understanding of the risk mitigation that is required in order to make funding available. So we set up to take more risk than most, and we can limit those risks, but obviously what we do is take the construction risk out of it by building the project and then refinancing it. So I think there's two things that developers lack, to your question. The first is a fundamental understanding of risk mitigation and what a financier requires to put in place funding. And secondly, given the nature of the LPs for the fund, being people like the EU, their objectives are more than just building a project. They want to make sure that they work with the community, they put in place the right ESG measures. So the last thing the EU want to do, for example, is put in place a project which has pollution issues, for example, or damages community relations. So it's very important to work with the community. Most developers don't do this. So development, community engagement, ESG metrics are all extremely important to our LPs. So the second part of your question was?
What are you doing to help to ensure that the companies that you invest in are able to get conventional finance and not just the special finance that you're delivering?
So the objective is that once we've built the project, as I mentioned earlier, we hope we're put in a situation where it can be funded. And typically we will stay in the project, help to organise the refinancing so we can actually free up some liquidity, and then eventually we probably sell it. But I think one of the things we really do bring to these projects is we get them to the stage where they are internationally acceptable to financiers. So most financiers will walk in and they will be comfortable with all the risk mitigation measures we've put in place, the ESG measures we have in place, and obviously the way we work with the communities and so on. If we have a community relations which don't work, we don't support the communities, then what's going to happen is the banks won't get involved.
Great. Thank you, Mark. And Chan, I would like to bring you into the discussion. You heard Mark say about the risks and mitigation strategies. So could you help us understand, let's say just what are the two non-financial risks that are most affecting the projects in Southeast Asia? And in your advisory role, what do you advise clients on how to mitigate these?
Yes, hi. We at ADL Capital, we are both an advisory firm across the region, and we are also project developers in our own right in the clean energy and infrastructure space. Our ability to advise actually also depends very much on having the domain expertise in the relevant areas, which we do because we actually do our own projects, right? So to the question, non-financial risk, right? So the first risk in, I guess, all of this renewable stuff is the ability to get the land, right? And land is complicated, right, in almost any of the countries that we are talking about in the region. I guess to even delve into this topic, it's a whole session by itself, so we won't go there. But rest assured that it is very, very difficult, ranging from Indonesia to India to any of the regional countries. It is a very, very big challenge, right? But this is also precisely where local developers typically have an edge, right? Because they are from the country, they have relationships, long-standing. Maybe they own the land to begin with, and all that sort of stuff, right? So that's the first issue. Another one, which is, I guess, non-financial still, I mean, all leads back to money eventually, which is why we are sitting here talking about the money, right? But another sort of non-financial issue is regulatory risk, right? So one of the big issues in, again, many of the regional countries is uncertainty around regulatory risk. Literally, the ground shifts under your feet, right? And some of these projects, when they are large, actually they take quite some time to develop, right? You take a hydro project, for example. It takes years to develop, right? And to not plan for the fact that the regulatory environment will change inside those few years is a non-starter.
Like, how do you plan for such a thing?
You can't, right? There's no way that you can plan for. Well, you can pray, okay, that's a start, right? But the fact is that you have to be nimble enough to, move with whatever the regulatory change is, and the ability to adapt to what the change is critical, right? And like I said, a lot of it, if we move back to the feed-in tariff era of things, I guess we're mostly moving away from that. But like one of the things back in the feed-in tariff era was that the feed-in tariff itself will change, and it can be quite dramatic, right? So we ourselves were doing, as an example, a biomass project in Indonesia, right? The supposed feed-in tariff was like 13 cents US, and sort of, after about 9 months, I woke up one day and it had become 6 cents. Okay, there's no way you can plan for anything like that. No project will withstand half the revenue disappearing, right? So in a way, you can't, right? But okay, not every time it's this kind of levels of drama, right? But you still, the key thing is that the project structure has got to have sufficient flexibility that you can deal with these things, right? There is no other way around it.
Thanks, Jan. I think you did bring some peace to mind by saying that these declines or halving of tariffs are not pervasive. It is rare, if I may. Okay, go to you. Great. Okay, Fatima, my next question is to you. Like, coming from a project development standpoint and hearing about the risks that Jan just mentioned, like Masdar has a big target. I think you're planning to build 100 gigawatts of renewables globally, out of which 10% could come from Southeast Asia. Yesterday, I was here at ACES, and everybody was saying that it's not financing, it's the environment in which you can, you need conducive environment to make profitable and sustainable returns. And that is what is, sometimes tricky in Southeast Asia. And you have entered various countries in Southeast Asia, you're eyeing more of them. So from your standpoint, what are the trigger points to make a financial investment decisions in these region? What are the key market conditions or policy signals that you need? That's the first part. And secondly, I'm going to ask you to rank or pick your favorite country in terms of where the investment opportunities are the best right now.
Thank you for that. It's not easy to pick, of course, my favorite country. Southeast Asia is very dynamic and every country is quite special. But maybe first, for those of you who don't know Masdar, Masdar is a renewable energy developer born in Abu Dhabi, United Arab Emirates, almost now 20 years old as a company and as an organization. You're right, we have a target of achieving 100 gigawatts by 2030. Today, we're very close to 52 gigawatts globally, spread across 40 countries, and we're very keen to expanding and strengthening our presence in Southeast Asia. We come a long way from the GCC all the way to Southeast Asia, and it's very important for us to have certain factors when we look at investing in the region. And when we look at entering or scaling into a new market, one important and fundamental factor is predictability. And I can resonate with my fellow panelists about sometimes having these rare situations where you wake up one day and things change. But I have to say that we've seen a positive trend across the region. We're looking at different elements. I think one thing is a clear renewable energy roadmap is very important, long-term government commitment, as well as policy stability. I think when these three things come together, it gives investors the confidence to deploy capital at scale, right? It's very important for us to be able to see as well credible government or credible offtake arrangements, I would say, because that means that you have a utility or a buyer who's willing to really absorb that new capacity that you're building. We're looking at countries such as the Philippines. They have made strong progress in or through the Green Energy Auction Program that introduces visibility, structured capacity allocations, as well as standardized PPAs. And that gives the investor a way to plan ahead and to plan with confidence when they want to come into the market. We've also looked at, grid readiness is very important. All that new renewable energy capacity has to be absorbed by the grid. And Malaysia, for example, has been investing a lot in modernizing its transmission network. And we're seeing that also through the National Energy Transition Roadmap, the NETR, which reflects the seriousness of Malaysia about scale and implementation. And that's key, right? You want to build your power plant knowing that you can evacuate your power at the end of the day. It's going to get from point A to point B. We look at factors as well as how open a country is to foreign participation. We come in as a foreigner, so we need to look at the ease of doing business, as well as the flexibility in foreign exchange convertibility. These are very important, and we've seen these in Malaysia and Philippines and Indonesia as well, in terms of the notable progress they've done. So I think ultimately we look for ambition backed by credibility, right? It's important that policies don't just sound good, but translate into implementable, bankable projects. And that's the kind of environment we see emerging today across Southeast Asia.
So actionable policies lead to bankable projects. Thank you. Saowalak, let's build on what Fatima mentioned, especially in regards to Philippines, that their GEAP auctions, they have been quite successful in scaling up the renewables industry over there. And this is something that we are seeing as a trend emerge in other countries as well. Various other countries are trying to look at auctions as the way to go ahead. And the other way is that you could also tie up with third-party energy providers for industrial customers. So could you help me understand what is one or two financial risks this time for the projects that don't have a government-backed PPA? How do you go about building or working over here? And with the transition towards auctions from feed-in tariffs, I mean, Thailand could also do that. This year may be difficult, but hopefully next year. How does that change your strategy of how you're going about developing projects in Southeast Asia?
Okay.
You're audible.
Hello. Yes. สวัสดีค่ะ Good morning, everyone. My name is Saowalak. As he just introduced, I come from Thailand. But as my current position now, I take care for the super energy group with a market. So let me brief a little bit about company. Super Energy is the Thai company established in 1995 and is listed in the stock market. Currently, we have invest in 2 countries mainly. That is in Thailand for around 1 gigawatt, and in Vietnam nearly 1.5 gigawatt at the moment. So then, because of myself focus in Vietnam in last 7 years, so then mostly I will share the perspective in terms of Vietnam investment combining with Thai. And I understand that what you're focusing is want me to share in terms of Vietnam market, right?
Vietnam or any other market that you think?
Okay, so actually then, because of, I don't want to talk, it's just only the principle or the theoretical part from the research. I will share in terms of like the real experience in the local player, not really local, like the one who is the foreign investor in the local market of Vietnam and Thai, okay? So let's talk about like if in Thai, when I start the work, the renewable energy is already been mature. So then many policy already settled that I think is not challenged. But move back to Vietnam last 7 years is just start in terms of like the real situation of promoting from the Vietnamese government. Until now, there has been developed a lot, including super energy itself. We can call that we are the first foreign investor there who do utility scale with the Vietnamese government. So let's talk about what he just mentioned, like move from FIT to the auction. So in fact now Vietnam is been in the situation like what I could say like blue situation for last 3 years because of their internal policy, the politics itself. I believe that everyone may heard about this new in the market. But however, in the next future, as I can see from the local payer now, we can see like a lot of opportunity and policies make more clear. So then in order to move from FIT to the auction, it doesn't mean like they have no cap at all. So Vietnamese government already settled the gap, like especially like we're talking about solar and battery now, they play the price something between 0.5 cent to 0.7, or even though like they have put the requirement that it must have 10% of the solar storage behind the meter. So the meaning is like, in fact, talking about the technical itself, you can share the grid and save electricity into your storage first to sell at the time that you can sell, right? But talking about like when it could be, so then now they settle like from the north, south, and the middle as the country topography itself, that with different price. I believe that if anyone interested to looking for the opportunity, that is open now. Beside that one, they also like open for a lot of big scale offshore wind, which is including government guarantee for 15 years, 80% offtake, which is never been happen for Vietnam. And I think in terms of finance itself, it's more clear in order to run, and you can see like when it could be the return of investment. On the other side, for the direct PPA, so that one is also very interesting for the CNI market. Because of, as every country commit with the net zero, then a lot of industrial sector also play as the big role to promote this kind of country target. Then they also even have like the clear policy for the direct PPA, including settle the wheeling charge already, which is roughly around 400 dong, maybe around like nearly $2 USD, which is, I think is makes sense. If compared to Thailand, in the past, we never like open what is the price of wheeling charge, but in fact, it gets settled around 1 baht, put inside of the FT price that everyone keep pay. And I think that is the real Thai is around 3 cents, Vietnam is around 2 cents. That is the willing chart we can see for the market to do the CNI or direct PPA. So that is the thing. I think what super energy also like move forward because of in Thai we very strong because we are local. But in Vietnam, during this waiting period of offshore wind, so we also focus for the CNI. And a lot of Thai industrial party also over there is very easy for us, but it doesn't mean we focus only Thai player. We also like talking with many international manufacturing there as well. Yes.
Thank you. And if I were to place bets, I think I would place more on DPPA rather than offshore wind. I mean, I'm slightly skeptical in the short term on that one. But speaking of DPPA, could you help us understand, like last year, the policies came up, were declared after a gap of 7 years, and since then there have been 2 further clarifications on DPPA, especially the charges, transmission charges. But still PPAs are not being signed yet. What's holding the industry back?
So then what I could say that the issue, so the meaning is in the detail of the policy itself is not clear 100% like what it could be, right? But what investors doing now, we're fighting the gap. I could say like a private PPA, which is like maybe can be open more for the big scale of the rooftop itself. As Mr. Chan just mentioned about like the constraint of develop the project related to the land. Vietnam itself also have very strict requirement of the land development. If the project is not put into the power development plan or even approved by the province level, ministry level, or so on. That is in Vietnam side. I think is quite challenging, but a lot of opportunity now.
Okay.
Actually, we just sit and then a lot of factories approach us because everyone trying to hit the target of the net zero, I think so. That's
great to hear. Everybody's trying to hit the net zero targets. Well, Priyanka, let's continue the discussion on the SMEs or on CNI part. Like one of the, again, at the risk of sounding very cliched, like there is this paradox in the finance industry that if you have finance, if you are wealthy, you get more finance. If you are not so wealthy, you don't get finance enough. And what's happening is that the small, medium enterprises, they often face a lot of challenges in acquiring financing. It could be various reasons because of lack of being able to provide collateral or lack of a track history or credit worthiness, meeting all the parameters of the credit worthiness. So what are the top financial challenges faced by SMEs or these CNI power users? And are there any innovative solutions that Mirova is deploying to overcome some of these challenges?
Thanks, Shantanu. And hi, everyone. Good morning. Just very quickly, I'm Priyanka. I look after the emerging market energy transition business for Mirova in Asia. So this question is very, very relevant and very important to answer and find a solution to, I think. SMEs actually form a huge part of the whole green transition that needs to happen in Asia. In some countries, even up to 40% of what needs to be done to move to the net zero targets of these countries. So these SMEs having access to financing is quite critical. And I've been a project finance banker prior to this for a very long time. So I can tell you that in this region, majority of the funding that is getting deployed in the energy transition space is commercial bank funding, right? And most of these SMEs will not make the cut when it comes to commercial bank funding. And there are multiple reasons for it. Banks as organizations are set up to fund large infrastructure projects, which is what they are doing very well. And the credit evaluation models of banks are set up as such where the risk of an SME or a small company is too challenging for them to even evaluate, to put in financing. And then the second big problem is the size. Some of these SMEs, the type of capital requirements that they have are too small for commercial banks to mobilize resources for, you know, a small CNI players, for example, in Vietnam or Thailand might just require, 10 to 15 million of funding for growth capital to expand their business, for acquisitions, working capital. And for banks to put in resources for these, it's just too small. These are some of the big challenges, right? Obviously, banking relationships not being in place, the sponsor track record come without saying, right? Because these are all smaller and newer companies that are trying to get into this business. So with these challenges in place, the commercial banking market is not really set up to respond to this. And which is where I would say private credit has a big role to play, and which is where Mirova comes in as well. Now, as Mark was saying initially, these are what is considered as marginally bankable or basically non-bankable projects or companies, right? And which is where private credit comes in, sort of handholds these smaller companies and SMEs. The credit evaluation model of private credit funds are built as such to take those risks better than the banking environment, right? With the use of blended finance, there is sort of a de-risking of some of these projects where we come in the initial phase, kind of handhold them, work with them to make their projects successful in the initial stage and sort of prep them to move ahead in future to take up more commercial sort of funding from the traditional banking market.
Okay. Chan, I'm going to move on. So we heard from Fatima and Saowalak that there is slight differences between foreign companies and local companies that are operating in Southeast Asia. And you often work as a bridge between these two entities. So based on your experience, what do you think is the perception of various risks? So political, regulatory, financial risks in the minds of the foreign players that are coming to, that are bringing in capital or technical expertise versus the local developers who are actually building the projects in Southeast Asia. And are there any non-negotiables on both the ends that you could bring us?
Yeah, I think the risks facing foreign investors and local investors, developers, local players are actually quite different, whether we like it or not, right? So again, and this differs quite dramatically across different markets. So the markets that have been very successful in attracting foreign investors, obviously at a policy and regulatory and legal level, have put in place, frameworks and legal frameworks, right, and laws that attempt to create as even a playing field as possible between local and foreign, and have, I guess, protections in place, for foreign investors. Now, almost by definition, I would say that foreign investors are inevitably disadvantaged, vis-a-vis the local guys who have been there, since and forever, and are deeply embedded within, the local networks, institutions, and so forth, right? And again, at least in my experience, and typically in many of the Southeast Asian countries around us, a handful of very large local conglomerates, families, and so forth dominate the local landscape, right? And that has carried into the renewable space, right? And this is clear in many of the countries around us, right? And what I think the foreign investor has the most to fear on is selective enforcement, right? The laws are always there, right? And the law will always say that everybody is the same, right? But practice and reality is not necessarily like that, right? I mean, if the law actually says that, well, you are treated one way and the local guy is treated another way, well, you wouldn't even be there in the first place, right? So I don't consider that a risk, right? Because you just wouldn't do it, right? But the law will say everybody is the same, right? But when stuff happens, okay, then reality is not necessarily the same. I think that is a very, very big risk. How to handle this? Again, there is no clear answer, because if there was a clear answer, everybody would do that, right? So, and that wouldn't be a problem anymore, right? So there is no clear answer, right? So I think that as many foreign players will tell you, having a strong local partner and a good relationship with such partner is a must-have. Okay? Now that has been treated as gospel, literally. You ask any foreign investor, that's the first thing they will tell you. But again, reality may or may not necessarily be like that. Okay? Sometimes your partner is a worse problem than the solution, right? So that is also possible.
Any examples? No.
Well, I can't get into that, right? But it is a fact, right? It is a fact. So if you have a really good partner, yes, that could be the solution to all your problems. But equally, that could be the problem to all your solutions, right? So I don't know what to say to that, right? So, but it is. There's nothing special about our space in renewables and all that is different from sort of the general world of business and commerce. That same statement applies, right? It's not. We are not something special. So that's how I see it.
Okay. Fatima, I'll bring you in again. Like Chan does lay the ground for you, I think, very nicely. One of the things you had mentioned earlier in your previous response was that one of the things that you look at is strong PPAs, strong off-takers, and then you try to make the investment decision. But what if you don't find one? Like in most countries we have, or many countries we have, government-owned monopolies acting as the only off-taker of sorts for large utility-scale projects. So in such a scenario, what would you do to increase the bankability of the PPAs, especially with some of these off-takers who may not be as credit-worthy as, let's say, what you might find back home in UAE?
I mean, that's a tricky question, because you're definitely right that you don't always find, the ideal case where you have your government offtake, long-term, fully credible, very strong credit rating, project site is perfect, resource is amazing, amazing local partner, as Chan was saying.
You wish, right?
So I think it's probably very far from reality, what you find. What we've done, since we were incepted, we've really gone through a learning curve as an organization. We have a very strong track record today that helps us identify issues from a while away. One thing that Mark mentioned earlier as well, which we look at in our approach, is always ensuring the right risk allocation in the projects. We look at different parameters. First and foremost, of course, ideally you would want to have a strong government that can back up with sovereign guarantees, through guarantees or letters of support or whatnot, to be able to somehow mitigate and give confidence not only to the investor and developer, but also to the lenders who are going to be brought on board of the project. We look at cases where currency can be an issue for a foreign developer like us when we come into the market. In Southeast Asia, a lot of the countries here have local currency dominated PPAs. We do prefer dollar-linked or partially indexed tariffs to help mitigate a bit of the currency volatility. However, in cases where we are not able to find that, we look at exploring options of placing local hedges to manage the exchange rate volatility. We work together with multilaterals to secure political risk insurance as well, in cases where you might have issues of payment delays or payment defaults as well, God forbid. And as well, we look at partnerships with DFIs. I think partnering with DFIs not only gives strength to the structure, but also signals confidence to commercial lenders as well. DFIs have, a more stringent procedure to follow. I think environmental and social matters, as Mark was mentioning, is very critical for us as well. And I have to agree that, not all developers might look into community engagement or making sure that you look at the local areas and getting their early buy-in is very important as well. So I think it's beyond just the offtake. Everything has to come together to give you that robust structure for a project that you would want to see. I think ultimately we don't see these risk mechanisms as barriers, more as enablers to eventually reach a fully market-driven renewable investment framework that you might have. And it also builds the credibility and strength of these markets to be able to sustain from big market changes that might come in the future. So I think we see them as opportunities and less of challenges.
Great mindset, I guess. I would like to push you a little bit more on what you mentioned on the multilaterals and DFIs. Like they can be slow in their workings, and obviously they have to take care of more parameters than, let's say, some of the local lenders. But doesn't that slow down the lending process? And how will you achieve your targets for Southeast Asia if you constantly rely on these DFIs and multilaterals?
I would say, definitely DFIs have a different process compared to commercial lenders, and they have more considerations that they would need to look at. In some markets which are a bit more challenging than others, you might need the DFIs to be with you, to be able to put together the right framework you need, not only to be able to get the government on board, but sometimes also to be able to give that confidence across all the stakeholders. So I would say that it depends on the project and the market that you're planning to enter, right? In some markets, commercial lenders, you're right, might be a lot faster, a lot more nimble in terms of addressing the different dynamics in the project, whether it's technology risk, whether it's market risk. And in some cases, you do need the DFIs who might have more insight into what's going on in the market and have the ears of the government to help support in pushing things through as well.
Thank you. Saowalak, let's change gears a little bit and let's talk about technologies. We haven't touched upon that very specifically. And what we are seeing is that, let's say Philippines is going for solar plus storage auctions. There are wind plus storage auctions. The part where I come from, India, we have what we call as complex auctions. So it's a mix of solar and wind and some form of energy storage, whether it's pumped hydro or it could be battery storage. So what do you think is the risk-return profile of various technologies in Southeast Asia? Or you could stick to one market that you are covering, one or two markets that you are covering. But how do you see these technologies evolving, and what is the risk and return profile?
I think because of talking about the Southeast Asia in terms of the country, the resource itself, of course, solar and storage. That is like, for the country like Thailand or a CLMV country, that is very much because of the irradiation is very high. That should be mixed with the battery in terms of, especially for some country like they have the issue of the grid digestions. That will be helpful for the investor itself. But on the other side, I also support for the wind as well, especially for the onshore. Why I focus for the onshore with battery first, that is like the scale is not too big, and in terms of the investment, in terms of like the capacity that should be installed to match with the technology itself is also very, very supportive in terms of the country context. However, on the other side, what I could see now, I see a lot of policy from many countries like in Vietnam. Government announced that EVN must put solar storage around 2,400 megawatt hour. So then into that system, the meaning that they will put it in like not only for the investor side, for the grid side, like substation, that is also will be implemented as well. That is also well helpful in terms of the application. But in Thailand, we also have a few pilot projects long time already from the EGAT itself, in the middle or in some part that have a lot of renewable energy. So then in my point of view, I think like from the country like in our ASEAN, that solar battery and wind battery, especially for the onshore, is like quite matched.
Okay, and on the battery side, are you seeing, what are you more confident about on the application side? Will it be standalone battery energy storage systems on the grid, or will it be storage paired with renewables that you are more bullish about, at least let's say till 2030?
Sorry, I cannot.
The
catch up.
application of batteries,
Yes.
which one is more exciting for you? Is it the standalone batteries on the grid, supporting grid for frequency regulations and such?
Frankly speaking, for me, because of what I've seen now is the curtailment issue. Some countries say that, no, I don't have like Thai. But in fact, they have a lot of shutdown, like, oh, I do maintenance, blah, blah, blah. That is the curtailment as well. So then if this kind of thing implement into the how do you say, the transmission line utilities, the substation utility to support investor, that I think is very good for the investor, yes. Because that is will help for reduce curtailment and like make sure that whatever they produce can take over.
Great, thank you. Mark, coming back to you, like you are active in various parts of the world. Your company is active in various parts of the world in providing financing, especially in LATAM, Africa, Southeast Asia. So are there any innovative examples of financing, or if not innovative, like successful successful examples that could be scaled up even further? I mean, learnings from Southeast Asia to outside, or from outside to Southeast Asia?
Good, thank you. I thought about this question when you posed it first to me, and I think, so the structures we apply, the three regions we cover, Asia, Africa, and Latin America, are similar. But I think each time we do it, there is some innovative elements to what we do. But I thought maybe you would take it back to blended financing itself. And the reason I do that is because I think that is an innovative structure that a lot of people aspire to and a lot of people haven't yet been able to achieve. And our structure, as I mentioned earlier, is equity. So the whole project gets constructed with equity. You don't require any debt. Now, the innovative structure is that because you have DFIs in there, the DFIs are prepared to come in and fund these projects with a first loss. So that means that they are the people who will, if the project has an issue, will take the first loss. That therefore means that the institutional investors will, to a certain extent, be quarantined from that and will still get returns and hopefully don't lose any money. The second aspect of what the DFIs do is they'll bring in capital, in our case, at inflation. So the returns are maybe at 2%. And we have another element which is a sort of a quasi-debt, which is 4% or Euribor linked. That therefore means that projects which may, for example, produce a 10% return on a fairly high risk basis, so higher than a bank would consider acceptable, they might produce a lower return, say 8 to 10%. But the institutional investors, because of the way it's structured across different tranches, will still get a return of maybe 14%. So I think that's innovative in the sense that it catalyzes investment in the sector for institutional investors that would otherwise not be in that sector. So the DFIs might put in $100 million, but that then allows 500, in our case, they put in 200 and it allows $1 billion of financing to be provided. The other part of it, the fund is set up into two parts, a development fund and a construction fund. So the development fund is all the DFIs, and what they'll do is put in $2 to $5 million to get the project up to a stage where it's financeable. So you act as a quasi-developer. What you do is just go through, do the due diligence, put in place the right ESG measures, put in place the right structures with off-takers, and we've talked about previously, and make sure the project is interesting enough that it can then go to the next stage, which is our construction fund. So the fund is $1 billion, but of that, $50 million is the development fund. The rest is construction. Therefore, it allows you to take projects, try to get them up to the stage where they can be developed. If they can't be developed, what then happens is they'll be pushed aside and the better ones will come along. So it is quite an innovative structure. It is quite hard to put together. It is quite hard to satisfy all the stakeholders, but it does mean that you catalyse investment. And the last point I want to make is, an example is in Vietnam, the PPA was considered largely unbankable. So we came in as a fund which could take a bigger risk on an unbankable PPA. We built 2 nearshore wind farms in the early stages of the wind farm development in Vietnam. That alone catalyzed quite a lot of investment by both local investors, local banks, but also foreign investors, because they saw that these projects could be doable. So I think it does work. It does catalyze, and we've done projects in all sorts of parts of the world, like Djibouti, for example. Probably half the audience here hasn't even heard what Djibouti is. It's in the Red Sea, but we've done a wind farm there, which there's no way that would have been done otherwise. Now that's been done once, you'll find that other developers will now come in and do a similar thing. Without the blended financing structure, I think you find it wouldn't have happened in the first place.
Thank you, Mark. I'll reduce my skepticism on offshore wind in Vietnam if you are the financier. Then Priyanka, similar question to you as well. Like, you are also active across all of the same markets. Are there any innovative project financing models that you are seeing? And what kind of problems are they really trying to address, if there are any new mechanisms that you think of?
See, for emerging markets and the type of investees that we work with, which are really small in size, I think those standard project finance structures may or may not work, right? Because while you may have traditional energy projects which have a standard PPA in place, where Mirova really brought a difference was, for example, in energy access in some of the Eastern African markets, which is where we started off. And what we were financing was literally the last mile energy access through solar home systems. And there you cannot apply a typical project finance model because these are pay-as-you-go kind of systems. So that's where we brought in innovative receivables, financing kind of structures, both on balance sheet and off balance sheet. And we've sort of brought those structures now outside of Africa into Asia as well, where we are doing a lot of microfinance, financing of these microfinance institutions to sort of, again, catalyze financing to the underserved population in these markets. So I would say we have to continue to innovate from that perspective. And as Mark was talking about blended finance models, this is exactly where we see a strong use case for blended finance models, because these are very, very risky transactions. How do you actually bring capital into some of these type of transactions? And you have to de-risk them for private capital to flow in. So we have been doing that for a very long time. We have now deployed and are deploying almost 11 blended finance models in various emerging markets, and which is what we have to continue to do in the Asian context as well, I would say.
Thank you. And sorry, I didn't get any questions on the iPad from the audience, but if you have any, please just stand up and you could ask any of our panelists. If not, I would actually like to pose a question to Mark on the exit opportunities. So please think of the question while Mark answers this. So one of the things, yesterday I was speaking with somebody and they mentioned that for big investors, AA, AAA rated investors, they find that the exit opportunities are not very clear, at least in Southeast Asia, and that is what makes it difficult for them to invest in this part of the world. What do you think of it?
So it's a really good question. I think generally private equity at the moment is struggling to find exits. Infrastructure is slightly different. Infrastructure, I think, is a little more of an attractive sector to be in at the moment. And the reason for that, I think, is the valuations are reasonable and they do generally provide annuity income. So I think to answer your question, I think there's sort of 3 types, and my background actually was an investment banker originally, used to M&A, so I've seen quite a lot of this, but the 3 types of investors will look at these types of projects, and it depends on the project. So I think the first type is a strategic investor, the second type is an annuity investor, and the third type is probably somebody who you'd call an infrastructure investor. Now, I'll give examples of each. So our first project we sold was called Clean Tech Solar, which was rooftop solar across the region. The off-taker for that, the investor who bought into that and ultimately is now the owner, was Keppel. So Keppel's obviously somebody who is well known, as you've heard this name quite a lot in this conference, but they will look at aggregating some of these investments, and because we've already taken the construction risk out of it, they're more interested, and obviously there's opportunities going forward for them to develop more. So they'll look at how they can perhaps expand on that and make more money from it. Annuity investors, typically they're investors who would come in and perhaps be a pension fund. A good example is, we have a gentleman over here, Lacasse. They will look at infrastructure and they will look at the annuity aspect of it for their pension fund. So this is one of the biggest pension funds in Canada, and they'll look at it from a perspective of providing annuity income for their pension holders. Then I think there's other investors like a Macquarie, for example, or a Meridian. Meridian's a French-based company, and what they'll look at is what they call yellow field, where they'll take an investment which is maybe built but has a lot of potential to expand, and they'll buy it and look at the opportunity to put more money in and expand beyond. But in our case, because we've built it, demonstrated the model works, taken the construction risk out of it, they'll look at the next stage. So I think it's a little bit of a horses for courses thing, but I think there are definitely investors for infrastructure with the right profile in the right regions, and it depends on what they're looking for.
Thank you for that detailed response. We have time for one question, if there is, from the audience. No. Okay, I'll not force you. Maybe what I can do is do a quick round of, get a quick one sentence, one word answer from everybody. So what I would like everybody over here to do is just think about one technology or one market that you're active in, and tell us what is that one policy or regulatory item you would like to see, which would either accelerate finance or would bring down the cost of overall financing for renewable projects. Saowalak, can I start with you from the other end? If there is one recommendation that you would like to leave the audience with.
So, from my opinion, to reduce the financial cost, right? That's what you mean. I think in terms of policy itself, especially for the context of Asian, the country like us, that is sometimes very difficult to interpret the law or regulation. I could say that way. Even I am the Thai, sometimes the interpretation in Thai is also different. When I work with Vietnamese, they also interpret in different, even their law as well. So then, of course, number one is change of law. Yeah.
Okay.
Yeah.
Thank you.
Number two, as I already mentioned.
Just one, maybe, in the interest of time. Sorry.
Yeah.
So Priyanka.
So then,
no.
because of in terms of just one, right? But
yeah.
I want to wrap up a little bit. Just share that is very important. But on the other side, I already share especially that if it could help to reduce 1 or 2% or open more for the finance capital, I think is related to the curtailment compensation as well. So that is for the context of Asian itself. So that's it. Okay.
Good one, curtailment compensation. Priyanka.
I think I would also like to talk about Vietnam, because I think as a market, it's a really attractive market. And despite all the regulatory hurdles in the country, they have managed to do what they have done with, almost 16, 17 gigawatt of solar power in the country. So I would say if they can solve the issue of curtailment, the grid infrastructure, I think it's only up to our imagination what this country can achieve in terms of renewable energy. So.
Okay. Well, Fatima, if you catch the drift, then Vietnam is actually a really good investment opportunity.
I'm actually going to choose a technology, not a country.
Okay, yes, please.
I would choose floating solar technology.
Oh, nice.
It has enormous potential in Southeast Asia, given the geographical nature of the countries. I would say one thing that would have the single most impact and would be a debottleneck is having a standardized regulatory framework that governs water rights, permitting procedure, managing multiple government entities in terms of inland water body use. So I think that's very important in centralizing the system.
Totally.
So I'm not going to talk about either those sort of things. I want to talk about intermittency. I just wish that the concept of renewables only being available at certain times, we can move beyond that. And the reason I say this is I think we need to think a lot more about governments thinking about how to privatise and bring in private sector investment into grids. Because that's, in this battery and storage, battery and solar is a fantastic solution, but we combine it with wind, we combine it with other things, particularly the grids. And if we can privatise some of these grids, or at least bring private capital in, it's going to change the whole game.
So I'm also not going to talk about any country or technology. Actually, I want to talk about risk management. So we touched on currency risk management earlier. So I think that actually currency risk has nothing to do with project risk. So a different way of thinking from large-scale investors could be to completely divorce the management of currency risk from the project. So for large investors like Masdar or climate fund managers, you can manage currency risk at a portfolio level, nothing to do with the project. Or an even better idea for some financial institution to create a program to manage this currency risk across all the projects in the country and offer this as a service to investors. Then you don't have to keep thinking about special structures or currency-linked PPAs for each and every project, which slows everything down. Right? And the currency risk really has nothing to do with a project as such. It is for the entire country.
All right. Well, that's our recommendation over here, ladies and gentlemen. Curtailment compensation, grids, floating solar, privatization, and FX. So with that, I would like to just bring an abrupt end to our panel. I'm sorry we are out of time and we really have to get off the stage. Thank you very much.
Thank you very much. Please get together for a nice family picture. Wonderful. Thank you very much. Please join me again for a round of applause for our panel. Very insightful discussion.